In the early 2000s, American banks sold the world a dream. Housing prices always rising, mortgages stamped AAA, risk turned into gold by clever math. But behind every safe investment, a silent flaw spread. Trillions in bad loans disguised as fortune. By 2008, the illusion collapsed, and the cost was catastrophe. How did the system fool everyone? And why did almost no one stop it? The answers start with the first link in the chain. A single mortgage, on its own, is just a promise. One homeowner, one monthly payment. But Wall Street found a way to turn thousands of scattered promises into something far more valuable. Banks gathered home loans from across the country and pooled them together. These pools became the raw material for a new financial product, the mortgage-backed security, MBS. The secret was slicing each pool into layers, called tranches. At the top sat the senior tranches, supposedly the safest, first in line to be paid, last to take losses. Below them, mezzanine tranches carried more risk and paid a bit more. At the bottom, the equity tranche took the first hit if homeowners defaulted, but offered the highest potential return. This waterfall structure meant that as long as defaults stayed within expected limits, the losses would never reach the top. Models, packed with optimistic assumptions, said the odds of the senior tranches failing were almost zero. Rating agencies stamped these slices AAA, the same grade as U.S. Treasury bonds. Investors around the world snapped them up, trusting the math and the ratings. Greg Lippmann, a trader who saw through the illusion, later said, "There was so much money to be made moving paper, it overwhelmed common sense. Nobody wanted to ask if the borrowers could pay. We just had to keep feeding the machine." The alchemy was complete. Risky home loans transformed into gold-plated assets, at least on paper. Mortgage brokers became the gatekeepers to the American dream, but their true loyalty lay with the next commission check. Every time a loan closed, brokers pocketed 2 to 3% of the principal, thousands of dollars for a single signature. The more loans they pushed, the more they earned, no matter how shaky the paperwork. Lenders paid extra for high-rate mortgages, rewarding brokers for steering borrowers into riskier deals. In the rush to feed Wall Street's appetite, traditional checks vanished. No income, no job, no assets, no problem. The so-called ninja loans flooded the market. Brokers skipped over pay stubs and tax returns, relying on stated income or none at all. Some applicants inflated their earnings on forms, sometimes at the suggestion of the very people approving the loans. These mortgages often started with low teaser rates, but after a year or two, payments jumped, sometimes doubling overnight. Few borrowers understood how quickly those costs would spiral. For brokers, the fallout did not matter. Their money came up front, long before the first missed payment. The system rewarded volume and speed, not caution or accuracy. As the pipeline filled with weak loans, the foundation beneath the mortgage-backed securities grew more fragile. The risk was everywhere, but the profits kept the machine running. Every morning, the world's biggest banks woke up facing the same question. Could they roll over the cash they needed to survive another day? The answer depended on the repo market, a hidden plumbing system where institutions borrowed billions overnight, posting mortgage-backed securities as collateral. Before the crisis, this collateral was treated almost like cash. Haircuts, the safety margin lenders demanded, were tiny, sometimes just 2%. But as mortgage defaults climbed and confidence cracked, those haircuts shot up. Suddenly, banks had to find far more cash to secure the same loans. A 5% haircut became 20%, then 30%. Some securities could not be used at all. Each margin call forced desperate asset sales, driving prices down further and triggering even more calls. The cycle fed on itself, draining liquidity out of the system hour by hour. In this storm, one name surfaced again and again: AIG. The insurance giant had written hundreds of billions in credit default swaps, promising to pay out if mortgage bonds failed. But AIG had not set aside enough cash to cover a real disaster. As losses mounted, its trading partners demanded more and more collateral, $15 billion, then $40 billion, then $85 billion in the span of days. AIG's reserves vanished. By September 16, 2008, the company stood on the edge of default. The Federal Reserve stepped in with an emergency loan of $85 billion, not to save AIG, but to keep the entire system from seizing up. For Wall Street, the clock had been ticking all along. By the time it rang, money itself had become scarce, and trust was nowhere to be found. In Stockton, California, the Rodriguez family signed the mortgage papers in 2006. It was a 3-bedroom house with a small yard, just enough space for their 2 kids to play. The monthly payment looked manageable at first, thanks to a low introductory rate. Their broker promised it was a smart move, that the house would only go up in value. No one asked for pay stubs or tax returns. The loan application was filled out in minutes, and the Rodriguez family walked away with the keys and a dream. 2 years later, everything changed. The teaser period ended, and their interest rate shot up. Overnight, the monthly payment nearly doubled. The family tried to keep up, cutting back on groceries and skipping doctor visits, but the numbers did not add up. Late fees piled on top of missed payments. Letters arrived from the bank, first polite, then threatening. In early 2008, the foreclosure notice came. By summer, the family was packing boxes, watching neighbors drive by as a for sale sign went up in the front yard. Their story was not unique. Over 10 million American families lost their homes to foreclosure between 2007 and 2014. For every abandoned house, there were children switching schools, parents skipping work to meet with lawyers, families forced to start over. The Rodriguez family's loss was a single thread in a vast unraveling. What began as a promise of security ended with trust broken, a home left behind. Lehman Brothers filed for bankruptcy on September 15, 2008 at 1:45 in the morning, the largest failure in United States history. That weekend, Wall Street's brightest and most powerful met behind closed doors, scrambling to stitch together a rescue. Bankers, regulators, and Treasury officials traded frantic calls, hunting for a buyer. Barclays and Bank of America walked away. No deal, no lifeline. By dawn, the news hit trading floors. 158 years of history was wiped out in a single press release. The Dow plunged 504 points before noon. Credit lines evaporated. Overnight, banks stopped trusting each other. A senior executive later recalled that it was like staring into the abyss. Money market funds, once considered ultra-safe, broke the buck for the first time in decades. Global markets seized. Within hours, the world's financial plumbing froze. Phones rang off the hook in London, Tokyo, and Frankfurt. No one wanted to be left holding Lehman Brothers paper. The system was paralyzed, and nobody knew who would be next. Liquidity vanished from the heart of the financial system. Banks that once loaned freely to each other overnight now refused to part with a single dollar. The London Interbank Offered Rate, LIBOR, spiked to levels not seen in decades, signaling panic beneath the surface. With every uptick, the cost of borrowing soared, choking off credit for businesses and households alike. The arteries of commerce constricted. Blue-chip companies could not roll their debts. Small businesses watched lines of credit disappear. The stock market, already battered, fell into a freefall. By the end of 2008, major U.S. equity indexes had lost more than half their value from the previous year's peak. Pension funds, college endowments, and retirement accounts shrank by trillions. Even the safest investments felt unsafe. Money market funds, long considered bulletproof, wobbled as investors pulled out in droves. The machinery of modern finance, built on confidence and daily trust, ground to a halt. For weeks, the world's largest banks stared across the void, unwilling to lend, unable to borrow, paralyzed by fear of the unknown hiding in each other's books. Today, global debt stands at a record $307 trillion, higher than before the last crisis. As new financial products multiply and oversight lags, The next shock may already be building. Trust is fragile, and unchecked risk never stays hidden for long. The next collapse won't announce itself.